Look at this mess. Index funds, mutual funds, hedge funds, ETFs. Does reading this list make your brain hurt? Good. That's exactly what the finance industry wants. They want you to feel like the guy on the right, confused, clutching your cash, and terrified to make a move. They use fancy jargon to keep you paralyzed so they can keep their fees high. But here's the secret they hate. You don't need a PhD in economics. You just need 10 minutes to unlearn their nonsense. Today, we're burning the jargon and looking at the raw evidence. But before we expose the industry, smash that like button and subscribe. It tells the algorithm we're onto something. Done? Let's dive in. We are going to make this simple plus practical. Forget the textbooks. Think of this video as the cheat sheet you wish you had in school. We aren't trying to impress Wall Street, we are trying to get you paid. Here is our attack plan. We'll cover what a fund actually is, the different types, how the suits manage them, the nasty risks and fees they hide, and most importantly, which one is actually meant for you. No fluff, just the roadmap. So, what is a fund? Ideally, it's you handing a bag of cash to someone else in exchange for a contract. It's basically saying, here, take my money, combine it with everyone else's, and go buy expensive stuff I can't afford alone. Think of it like a party. You want sushi, soda, cake, and a DJ. Alone, you can only afford a sad bag of chips, but if everyone throws cash in a jar, suddenly you have a massive budget to throw a legendary bash. And the best part? Everyone benefits from it. You didn't buy the whole cake, but you get a slice. In a fund, you don't own the whole company, but you get a slice of the profits. It's shared glory without the full cost. Here is the flow. Your money bag goes into the investment fund, the bank building. They invest it, the market does its thing, and eventually the profits flow back to you, the happy guy at the desk. It's a money printing loop if you pick the right one. Now, let's look at the types of funds. This is where people get tripped up. Just like there are different genres of movies, there are different genres of funds. Some are horror stories, some are boring documentaries. You need to know which ticket you're buying. First up, the index fund. The advice you'll hear everywhere is throw your money into an index fund and forget about it. Why? Because it's the financial equivalent of putting your car on cruise control. It's boring, but it stops you from crashing. An index fund doesn't try to be smart. It just follows a list. Think of it like the NBA top 5 scorers list. The list doesn't predict LeBron James is good. It just lists him because he scored the points. An index fund just buys the winners. Take the S&P 500. It's just a list of the 500 biggest US companies. See how Nvidia and Apple are huge blocks, bigger are more weight. If Apple sneezes, the index catches a cold. You aren't betting on one horse, you're betting on the whole track. Then there's the NASDAQ. This is basically the computer nerd index. It tracks the 100 biggest tech companies like Apple, Microsoft, and Amazon. If you think robots are taking over the world, this is where you park your cash. Next is the Dow Jones. This is the boomer index. It tracks industrial giants like Coca-Cola and Boeing. It's less about flashy tech and more about companies that have been around since your grandpa was wearing short pants. But it's not just big US companies. You can buy index funds for small companies, international markets, or emerging economies. The rule is always the same. No picking, no guessing. You own the whole haystack, not just the needle. These funds are passively managed. See this guy with the crossed out magnifying glass? That means there's no expensive suit in a Manhattan high-rise picking stocks for you. The list updates automatically. No human ego involved. Because robots don't need yachts, the fees are super low. We're talking $0.2 to $2 on a $1,000 investment. That is practically free. Wall Street hates this because they can't buy a second summer home on 0.20 fees. Who sells these? The giants. Vanguard, BlackRock, Fidelity. Note, I'm not paid by them. They are just the supermarkets of money. You walk in, buy your generic brand index fund, and walk out. Simple. Here is the superpower. Less risk through diversification. Instead of panicking over one crossed out stock on a list, you own the whole heat map. One company goes bankrupt, who cares? You own 499 others. It's bulletproof vest investing. So how do you get one? Buying and selling index funds is usually done through a brokerage. You just add it to your cart like you're shopping on Amazon. But there is one weird quirk you need to know about. Unlike stocks or ETFs with traditional index funds, you cannot buy in real time. See that clock? You can't day trade these. You place your order and you sit on your hands until the market closes. That's because the price, or net asset value, NAV, is calculated once a day after the market shuts down. You place an order at 11 a.m., but you won't know the exact price you paid until dinner time. You also have to watch the cutoff time. If you miss the deadline set by the manager, your order gets bumped to the next day. It's like trying to mail a letter, miss the pickup, and you're waiting 24 hours. Sound annoying? I don't care, says the long-term investor. You don't have control on the price, but for a 30-year plan, a few cents difference today is meaningless. It keeps you disciplined and stops you from panic selling. Why are they so popular? Low cost, low effort, and great past performance. Even Warren Buffett loves them. When the greatest investor in history says, buy this, you probably should listen. Now enter the villain, mutual funds. See this guy saying, I am the manager? These are actively managed. This guy thinks he is smarter than the market and he wants you to pay him to prove it. He holds meetings asking which stocks should we buy, trying to beat the S&P 500. But spoiler alert, this is actually really difficult. Most of these experts fail to beat a simple robot over the long run. The worst part? Higher fees. You are paying for his suit and his stress. Expense ratios are often 0.5% to 1.5%. That sounds small, but over 30 years, that fee eats a massive chunk of your retirement. Is there any reason to buy them? Maybe. If you believe in a specific manager's strategy or need exposure to a weird specific sector, but for 99% of people, it's usually just an expensive way to underperform. Be careful. Places like Vanguard sell both types. You have to use your magnifying glass to identify if it is actively or passively managed. Don't accidentally buy the expensive one just because the logo looked familiar. Just like index funds, mutual funds are also priced once a day and have that annoying cut-off time. So you get the inconvenience of the index fund combined with the high fees of the active manager. Worst of both worlds? Maybe. Then we have the hedge funds. See the diamond? These are for the rich kids. They chase bigger returns using risky strategies like short selling and leverage. It's basically gambling with a tuxedo on. The fees are criminal, the 2 and 20 model. They take 2% of your money just for showing up and 20% of your profit. Plus, you get higher volatility. Unless you have screw you money, stay away. Finally, the hero arrives. ETFs, exchange-traded funds. It is a mix between funds and stocks. You get the diversification of a fund, but you can trade it on your phone instantly like a stock. With an ETF, you can buy or sell whenever you want. Market open at 10 a.m., buy, lunchtime, sell. No waiting for the NAV calculation at dinner time. It's total freedom. And the cost? Expense ratio, 0.03% to 0.75%. Just like index funds, they are passively managed. You get the robot pricing with the day trader flexibility. It is the best upgrade you can make. Plus, most modern brokerages have no commission fee to trade them. The platform you use charges you $0 to buy the ETF. It has never been cheaper to build wealth. So, here is the leaderboard. Index funds, charge ETFs, take the gold. They are low cost, easy, and give you instant diversification. This is where smart money lives. Mutual funds take the L. You are betting on a fund manager's strategy, which brings higher fees and uncertain performance. Why pay more for less? And a hedge funds? That's a treasure chest surrounded by traps. Not for the average investor. Leave that to the guys who want to risk losing it all for a story at the country club. So here is the big picture. The finance industry tries to sell you complexity because complexity pays their bills. But the data proves that a simple, boring, low-cost index fund, or ETF, usually beats the expensive experts over time. Your next step? Stop looking for the perfect stock. Go find a low-cost S&P 500 ETF, check the expense ratio to make sure it's under 0.1%, and just start. If this video saved you from buying a high-fee mutual fund, you owe me a like. Subscribe for more no-nonsense money breakdowns. See you in the next one.